Well, hi there. So in this video, we're going to actually wrap up economics. It's kind of a weird feeling. Like this is the beginning of the end. We don't. This is not the very last video that we'll be doing together, but we're getting there, right? 10.3 Forex is the very last topic. So let's get started. So Forex just means foreign exchange. So that's the first the first hurdle to translate what even the name of this is, and that means we are exchanging one currency for another. Now, throughout this lesson, and actually throughout kind of the next few lessons, I think it's helpful to just kind of remind yourself that currency behaves just like everything else. When we talk about currency, it can get really confusing because you're going to price one currency in another currency. So it's going to be like, how many euros per dollar? And it confuses people. They're like, what? Huh? So at the end of the day, the way that I remember it, it's just strapped around my neck, is that it's just like a cheeseburger, right? Like a Big Mac, which is what that photo is. And then it's just, how many Big Macs per dollar can you get? Or how many dollars per Big Mac is what the price of a Big Mac is in dollars, right? Is how many dollars per Big Mac. And that's, I think, a useful thing to kind of remember. Now, as we get started here, the first thing to know is that no matter what, if you are talking about buying something in another country, whether it's a good or a service or a financial asset like a stock, bond, or real estate, it has to be in that country's currency. So if a foreign person were to come to the United States and want to buy real estate here, they have to pay in dollars. Likewise, if we were to go to another country and we go to China or something and we want to buy something, you have to pay in yuan. You can't pay in dollars, at least in our kind of rules that we're going to use here. And so what that really means is then that we can derive from that the idea that any demand for a country's currency is really just derived from the demand for a country's goods, services, and assets. So there's no need to have Chinese yuan unless you're buying Chinese goods, Chinese services, or Chinese assets. And likewise, there's no need for a Chinese person to have US dollars unless they are buying US goods, services, or financial assets. Now, the things that most commonly shift the demand for a country's currency are kind of all related to that, right? The first would be tastes. So if there's more demand for a country's goods, like there's a taste for them, then there would be more demand for that country's currency. So it kind of aligns that way. If there's higher prices in a country, then it's going to actually make the demand for another country's goods greater, and it will make that other country's demand for their currency greater. So in other words, like if you have two countries, the United States and Mexico, and prices go up in Mexico, then it's going to increase demand for American goods. And that's going to be true of both Americans and Mexicans, because either one, they're going to look at it and go, the Mexican stuff's more expensive now, so I'm going to buy more American stuff, which means from the Mexicans' perspective, they need to have more dollars. If the income of a country changes, so we'll kind of use Mexico and the United States again here, if basically the income of Mexico goes up, then they're going to demand more stuff from the United States. It's the idea that if they're spending 10% of their income on American-made goods and their income goes up, well, then that 10% is a larger amount. So if they demand more goods, they have to demand more US dollars. On all of these work the reverse as well. If the interest rates change in one country, let's say the interest rates in the United States go up, then it's going to cause more demand for that country's financial assets. And that one sometimes confuses people. They go, what? Huh? And just kind of back up and say, basically, if the bonds, right, loans in the United States are paying really high rates of interest, then people who are wanting to kind of loan money to people will say, oh, gee, I really want to loan my money there where I can get that high rate of interest. So I'm going to demand more of those bonds, right? So the Mexican will look at it and go, oh, I want more American bonds because they pay a higher interest rate. And when they need those, they want to buy more American bonds, well, they need more American dollars in order to buy those. Now, there's another little trick to all of this. If this doesn't make your brain hurt already, and just remember and if it does, just kind of remember the currency demand is just derived from a country's demand for goods, services, and assets, right? The tricky part is that when one country's demand goes up for its currency, there's an increase in the supply of the other. And that's because, like, if you're a Mexican person and you're wanting to buy more American stuff, so you're demanding more US dollars. in order for you to buy those dollars as a Mexican person, you have to supply more pesos. So anytime the demand for one currency goes up, the supply of the other one has to be going up because they have to be supplying more to this foreign exchange market where the currencies are exchanged for each other. Now we're going to graph them. And I think that that actually sometimes helps a little bit to wrap our minds around what this kind of thing looks like. Now, the first thing to remember is that really these are just supply and demand graphs. So we have quantity here, and I don't want you to graph Big Macs. It's just an illustration here, right? And you think about that we normally would put price up here. And when we talk about price, normally what we're saying is how many dollars per Big Mac, right? So if this is the Big Mac market, then it's how many dollars per Big Mac. And this is the supply of Big Macs and the demand for Big Macs and the quantity of Big Macs. And we can just as easily swap that and say euros, right? The price of a euro in dollars is dollars per euro. This is the euro market. This is the supply of euro, the demand for euro, the quantity of euro. Now we're going to have to do two side-by-side graphs. And one of them is going to be for euros and one's going to be for dollars. And we actually told that right up here. So we'll make this one the euro market and this one the US dollar market. And just to make sure we keep track, it's a good idea to label Q sub euro and Q sub USD here. Now we have a demand that's downward sloping, and that's the demand for euro. Now who is demanding euros? Well, it's not European people because they already have them. The European people aren't demanding them. They don't need them, right? They've already got euros. The people who are demanding the euros are the Americans. Now, over on this side, you have demand for US dollars. Now, who's demanding these? It's not the Americans because they already have them. The Americans have the dollars. It's the Europeans who are going to demand them in a foreign exchange market. And we've got a supply curve, S sub euro and S sub USD. And just the same as with demand, we think about who's supplying the euros. Well, it's the Europeans. They're the ones who are going to show up in the euro dollar market, and they're going to bring the euros, and they're going to say, we'd like to get more dollars. So the supply comes from Europe in that sense. Over here, who's supplying the dollars? Well, it's the Americans, right? Because they're bringing the dollars and they want to demand the euros. But the one thing we've left off of these is the price. And the hard part for students, and I'll kind of flip back to this Big Macs, is US dollars per Big Mac, right? That's when we say a Big Mac is $3, it's $3 per Big Mac. So for a euro, it's how many dollars per euro is it? So we have this kind of little fraction and we say US dollars over euros. And what that's telling us is that it's the price is in dollars for 1 euro. So it's like $5 US per euro or $3 US or however many dollars per euro it is. Now over here, it's going to be how many euros per dollar. And so we just say euro over US dollar, right? Now the trick to this, and the easy way to remember it, I think, is bottom, bottom, right? Because students don't always remember how do we set this up over here. The bottom, US dollars, should match down here, the US dollars. Likewise, the bottom over here, euros, should match over here, the bottom, euros. So that's how we can kind of remember how we're labeling the price correctly on these. It's bottom, bottom, right? So if it's the euro market, quantity of euros, that goes on the bottom, right? So bottom, bottom. All right. Now, what we're going to do, so there's your labels tip, bottom, bottom. We only are going to do 2 currencies at a time. What we're going to show is the effect of an increase in one or the other. So for this problem, maybe let's say that the Americans all of a sudden develop a taste for European goods, right? So that's one of our shifters. The Americans want more European goods. And so in order to buy those, they're going to need more euros to do that transaction. So we're going to shift the demand for euros to the right. That's an increase. And we see that the price of euros goes up. And we call that upward price, we call that appreciation. Get it? Ha, 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 appreciation. So that currency appreciated. It means the euro went up in value, up in value. So now the euro is more valuable. But what happens over here? When the Americans needed to buy more euros, they had to bring more dollars into the market. So we're going to shift supply over here to the right. and it causes a downward movement, right? And that downward movement is depreciation. So the US dollar depreciated at the same time that the euro appreciated. And they have to do that. Both currencies cannot appreciate or depreciate. One is going to be appreciating when the other is depreciating. One of them is going to have a demand curve shift, the other is going to have a supply curve shift. And so you're kind of have some clear rules about how these movements work. So that's how it works, right? It looks basically like that. It's supply and demand. The tricky part is the label, bottom, bottom. Now there's some other additional things we're going to learn that are implications of foreign exchange a little bit. So the first thing is that actually foreign exchange can affect net exports. So just like we would say that, you know, the currency value can be affected by the demand for a country's goods and services and whatever, it also, currency values can affect net exports. And here's how. If a country's currency appreciates, it goes up in value, like what we had with the euros here, then it's going to cause its exports to go down and its imports to rise. And that will actually cause, right, in the long run, these two currencies to move back to where they started. And it'll kind of equilibrate them. Now, in reality, right, currencies move around all the time for a whole host of reasons of supply and demand. Maybe a country's income or interest rates are different. And so that could affect net exports. Now, you might be asking, like, why? Why would this be? Well, if a country's currency is going up in value, it's more expensive to buy the goods from a foreigner's perspective. It's more expensive to buy that country's goods because from that country, from the foreigner's perspective, they show up and they say, I'd like to buy some stuff from Europe. Well, now when they convert their dollars into euros, they don't get as many euros, right? Because the euro is more expensive. And so when they get these euros, they go, gee, I only got a couple of them. I can't buy as much European stuff as I used to. And so it causes European exports to go down. At the very same time, the Europeans now, their currency is much more valuable. It's gone up in value. And so they look at it and they go, ooh, stuff in the United States is relatively cheaper because when they turn their euro into a dollar, they get a lot more dollars than they used to. And so the imports will rise from the United States. The reverse of all of this is true, right? When a country's currency is depreciating, it will cause its exports to go up and its imports to fall. Now, this is different, right? This is kind of saying like, what happens if this is the initial event? If the initial event is a country's currency has gone up in value or depreciated or something, it has this effect on exports. It obviously can go the other direction if basically if a country decides, oh, we've got more of a taste for one other such and such country's goods and services. That would affect the exports and thus affect the currency. So it can kind of be a two-way street in some extent, okay? Now, the last part is actually explaining how foreign exchange works to balance the two current and financial accounts. So let's think back from the previous topic where we had this current account with mostly goods and services and a financial account with financial assets. And so that was stocks, bonds, and real estate. So for example, let's say we start with a change in interest rates, and therefore it's going to change the current account. So we'll kind of walk you through what this would look like. If the interest rates are higher in the United States compared to the EU, so that's the interest rate change, it's going to cause the EU to have more supply of loanable funds over to the US loanable funds market. That's because the Europeans are going to go, oh, the US loanable funds market has a higher interest rate. When they do that, the US financial account is going to move to surplus. That's because lots of money's flowing into the United States in stocks, bonds, and real estate, right? If the interest rate's higher there, that's what they want. They want more bonds. And so money's flowing in on the US financial account. But when they do that, when they buy all those US bonds, right? They're buying US bonds, they need US dollars. So the Europeans are going to increase their demand for US dollars. And so all of this is kind of happening at the same time, right? When that happens, when there's an increased demand for dollars, the US dollar appreciates. It goes up in price and the euro depreciates. And that's just kind of the movement over here, right? If the currency demand goes up, the currency appreciates. Now, when that dollar appreciates, it causes US exports to go down and imports to go up, right? We just talked about that. When a currency appreciates, exports go down, imports go up. And so the US current account, which is where goods and services are exchanged, is going to move towards deficit, right? So this is like net exports. And so the net exports are going to move towards deficit and outflow, and it will actually balance these two amounts. So that's why the current and the financial accounts actually have to balance each other. It's because the idea of a currency exchange causes them to have to balance, because every dollar that flows in is going to be balanced by a dollar that flows out. Now, we can also look at it from the other perspective. What happens if maybe net exports change? So, for example, if for some reason US exports go down and US imports go up, right? Maybe the US decides they really love European made stuff. And so they start importing lots and lots of European stuff. Well, that causes US current account to move to deficit, right? That's the idea of net exports are in the current account. And so money's flowing out to Europe. When they do that, the Americans, when they're doing that, they have to demand more euros, and that causes the euro to appreciate. That's literally what we just drew up here. When the euro appreciates and the dollar depreciates, that actually makes US financial assets less expensive for EU lenders. So in other words, the dollar is now cheaper. So if you're a European and you're going, I want to buy some US stocks, or I want to buy some US bonds or real estate, and you have euros, well, your euros now buy more dollars. So you take your euros, you exchange them into dollars, you get a whole bunch of dollars. So it makes the things that you want to buy, the US financial assets, cheaper because you can buy more of them. So EU's supply of loanable funds to the US loanable funds market go up, and it makes the US financial account move towards surplus. Because again, all of those stocks, bonds, and real estate are relatively inexpensive for foreigners, so they would move their money into the US stock market, the US bond market, and the US real estate market, and that's an inflow on the financial account. Again, balancing out that current account a little bit, so they balance each other. All right, so hopefully this helps you a little bit of understand the basics of Forex and how it connects to the current financial account. I'll see you next time.